All right, perfect. Welcome, everyone. Thank you so much for taking a little bit of time out of your evening to join us for a discussion about navigating turbulent markets, which I think is a very timely topic, given a lot of what we've seen since the turn into 2022, and especially here the last week or so. Before I introduce our guest and we get into the meat of our discussion tonight, sorry if you hear there's an ambulance driving on the street outside my window. It's a little distracting. I know some of you are current clients of ours. Some of you are friends of clients of ours. And then I know we actually have some of you who are joining who are investors in the venture capital fund with our friends at Mammoth Scientific. We're very honored to have all of you tonight. Thanks so much for taking a little bit of time to join us. So before I turn it over to our friends at Dimensional and our guest Apollo, I did want to tell you just a little bit about how we think about portfolio management in the context of financial planning. By the way, I'm Lauren Oshman. I am one of the partners and a financial advisor here at Vestia Personal Wealth Advisors. I actually think about a conversation that I had very recently with a physician executive. He came to me just to see, he was like, I have money that I have sitting in different accounts. I have some people that are helping me with it, but I just don't know if there's anything that I could be doing a little bit better. And so he wanted to have a conversation. He was introduced to me through an existing client of mine. I said, sure, let's hop on the phone. We can talk about it. So he walks me through. He's actually done a great job. He has a patent. He owns a business. He's amassed a good amount of wealth. He had that in a few different pockets of different accounts that were being managed by a couple of different advisors, or few advisors actually, that he had met at different stages of his career. And I kind of thought, as I was listening to him talk, he's got a good amount of money. He has professional help. He has people looking out for it. He probably feels pretty confident about what's going on and how it's being managed. Turns out it was the opposite. He had a lot of confidence in the people that he had chosen. What he told me, though, as we were talking, is he had a lot of goals for himself. He wanted to be able to give impactfully to a hospital he had volunteered at overseas. That meant a lot to he and his family. He wanted to be able to endow a scholarship at he and his wife's alma mater. He wanted to pay for private school for both undergrad and graduate school if they wanted for his children. He also wanted to have the ability to have work be optional at some point. And he was like, Lauren, I have no earthly idea whether or not what I'm doing is going to help me accomplish any of that. He said, I don't know if I need to work harder, because if I want to do this stuff with charity, that means I don't have enough for my kids' tuition, and I don't know how to figure out how much that's going to be. He had a total lack of clarity, because what stuck out to me is he had an investment strategy, but it wasn't supporting a broader plan that was being informed by the goals that mattered in terms of what he wanted his wealth to accomplish for him. So we dug into those goals. We're now working with him to help him kind of put together that strategy. What that is changing for him, you're going to hear Apollo talk about a lot of short-term things that are happening in the markets that previously, for this physician, he shared with me, were very anxiety inducing. He's like, look, if I see red numbers on my statements, I think my kids aren't going to college. Whereas now we've set him up with a plan dial where he's actually able, rather than focusing on his investment statements, he's able to look at, am I still on track to achieve these long-term goals that are really important to me? Is my wealth still working toward what I ultimately want to accomplish in my life? And that's changing the game for him. So if you have that strategy, you have that financial plan, and you feel really confident in it, that is awesome. You will learn a lot today about kind of the short-term things to think about with investments, and just have confidence that we're going to get through some of these tumultuous times. If you don't have that and you would like to, or even if you feel like you have someone helping you, but maybe a second opinion would give you a little bit more confidence, our website is vestiaadvisors.com. You can fill out the contact us form, and we would love to have a conversation with you. So a couple of housekeeping things. There is a Q&A. If you go like halfway across your screen on your Zoom bar, there's a Q&A button. If you want to ask any questions, chat them in there. I will be looking at those. We also have Robert Kennedy, who's with Dimensional, who is kind of working behind the scenes to monitor those questions. So feel free to send them in there. The other thing Apollo wanted me to make sure to tell you is to put your Zoom in the upper right-hand corner, choose speaker view in your Zoom options. That way, when he shares slides and numbers, you'll see those full screen and you'll actually be able to read the numbers. So choose speaker view. That should set you up with your Zoom. With that, I am going to introduce Apollo. I'm actually going to read because I don't want to miss any of his qualifications here. Apollo Lupescu is a vice president at Dimensional Fund Advisors, which is one of the premier investment managers in the world, managing over $650 billion in assets. He's a nationally and internationally recognized speaker who has delivered hundreds of lectures and seminars to financial professionals and individual investors on various investment topics. Apollo is considered by his colleagues the secretary of explaining stuff because he has a knack for explaining complicated issues in a clear and understandable way, which is why we continue to have him back for these events. Apollo has been with Dimensional in Santa Monica for over 18 years. Prior to that, he taught at the University of California. He received his PhD in economics and finance from UC Santa Barbara. He also holds a BA in economics from Michigan State University, where he competed and coached water polo. Rumor has it that he is still an avid player, but during the pandemic, he picked up another water-based sport, surfing. My guess is that's another webinar. Thank you, Apollo. It's so good to have you with us tonight.
Hi, Lauren. Thank you so much for the invitation to come back, and thanks to everyone for taking the time this afternoon to attend the webinar. It's great fun talking to you.
Perfect. Well, I don't want to hold the good stuff off any longer. So I thought it would be nice to set the stage, maybe tell us a little bit about Dimensional before we dive into some of the topics that are a little bit more timely. We do use Dimensional in a lot of our clients' portfolios. Some people have heard of it. It's not as much of a household name as some of the other mutual fund companies. Can you just give us a little bit of background on Dimensional? And in particular, how does Dimensional drive value for investors compared to like your traditional indexing strategy that other mutual funds use?
Right. It is certainly not a household name, but it is probably one of the largest investment company that nobody's ever heard of. I mean, not nobody, but a lot. It's not in the public eye. Right now, Dimensional as an investment company manages roughly about $650 to $700 billion in assets for various clients. And what's interesting is that it is not a household name, because even as we were established back in 1981, so we crossed the 40-year mark last year, Dimensional does not work directly with individual investors. And over the years, the Dimensional client base has either been the large institutional investors, and these could be pension plans, endowments, foreign sovereign funds, or clients of certain financial advisors. So we don't work directly with individual investors, but rather within the subset of financial advisors, we work with a certain number of firms with which we have some sort of an alignment in the way that we see the investment process. And for those firms, then we actually provide them the access to mutual funds, and also the ability to tap into the research that Dimensional does. And I think what really sets Dimensional apart, speaking about the investment strategy, is that traditionally you have had two ways of investing money. There are certain mutual funds who put as value proposition the fact that they can pick the right stocks, they look out there and they say, I'm going to just own this handful of stocks that I think are going to be the best performance and leave out everything else. Or they decide that this is a good time to be invested, this might not be a good time investing, technically called market timing. And those funds, they traditionally have been called conventional active management. And what we believe is that at this moment in time, given the speed with which information travels, given the availability of information, how competitive the markets are, it's really not possible to consistently outperform with the system, because there are too many investors out there who are looking at exactly the same data, who have access to the same information as quickly as the other manager. So because of that, we don't believe that the best way for an investor is to engage in those type of activities, stock picking or market timing. Might have been the case at some point in the past, but certainly not today. The alternative to that has been what's called index funds, and index funds are mutual funds that really license a list from a third-party provider like the Dow Jones or the S&P 500. There are others like Russell or MSCI, and these lists have been created to measure market performance as a whole, or for a particular sector in the market or asset class in the market. And as investors have realized that these lists, who are just basically trying to be as comprehensive as possible, these lists, these very comprehensive, broad measures of the market, are actually doing better than these stock pickers, and they're a lot less expensive. Well, there's certainly been a great deal of demand towards these index funds. And we do think that index funds, because they're more diversified, they tend to be a little more tax efficient, they have just more transparency. They are, generally speaking, a better solution than the stock pickers. So I think that index funds, if you ask me which ones are better between the conventional, active, or index, I think index is more diversified, it's lower cost, more tax efficient, more transparent. So certainly benefits that you can put in the index fund category. What Dimensional does is realize that this idea of a broadly diversified asset class type of exposure into a fund is very powerful. And yet what we found is that if you are licensing another entity's list, like the S&P 500 list, well, you're not alone. There are dozens, if not hundreds, of other managers who do exactly the same thing. And the mandate of these index funds is to track that list, to have exactly the same stocks in the same proportion. So what Dimensional has done over the years is basically came up with this idea that instead of being focused on that list, let's just look at the dynamics in the market and really build these comprehensive asset class lists, not based on what like a provider like a Dow Jones or the S&P would put in there, but what is the academic science? What is this rigorous scientific research that's coming out of the academic world? What is it saying about dynamics of different returns that we expect as investors? And so the way that we build our funds, they are comprehensive, they are tax efficient, they're diversified, transparent, pretty much a lot of the benefits that indexing does. But on top of that, the first layer is a greater focus on the type of stocks that traditionally, historically, have delivered higher expected returns to investors. And at the same time, the ability to implement this in a much more flexible way than an index. So we're not a conventional stock picker. We're not an index. We're actually sort of like the best of both worlds. But if you ask me, we're a little bit closer to this asset class diversified approach because of the similar cost, the tax efficiency, and the transparency. So that's kind of how we got to be where we are. And among financial advisors, I think that we're ranked probably the most reliable and trustworthy firm, even as outside of the advisor community, we might not be a household name. It didn't make any sense for us to advertise, go buy our funds if you couldn't do it unless you worked with a fee only firm who has access to these funds.
I know we'll get into this, but I was actually thinking about, there's headlines today that index funds are going to have to divest of Russian holdings.
Right.
And I was thinking that all those funds are going to be doing this, making that move at the exact same time. And there could be some pricing errors for sure in having to make those movements. Whereas Dimensional you all would have the ability to do that in your own time. And I know have already actually done most of that before any of this came about.
Way before that, and this is something that we were never hamstrung by following whatever somebody else is doing. We're not in that herd mentality. So as you said, years ago, we kind of realized that there is a lot of risk for investors in Russia. So the first thing that we did years and years ago is not necessarily participate in the local stock market and having to transact in rubles. But years ago, we moved to a different model where if we wanted to get exposure to some of these Russian companies, it has to be through another form of investment called ADR, or American Depository Receipt, where you can buy those securities with dollars rather than rubles. So in terms of just exposure to rubles, we've looked at this years ago. We've also looked and when it comes to Russian securities, realizing some of these risks years ago, we reduced the weight of the Russian stock market to the point where, to the end of last year, in a globally diversified portfolio, basically you can say that all the Russian securities amounted to less than 10 cents out of $100. It was less than Malaysia or Indonesia. So certainly a very tiny exposure to these Russian securities. Not that we foresaw the conflict. It was just something as part of the dynamic process that we've had for 40 years or so in assessing different markets around the world.
Yeah. So along those lines, I mean, this is the topic that is on everyone's minds. I would not be surprised if this is the reason that a number of people signed up to attend this webinar. So given, I mean, we already were in a volatile market environment to start 2022. That was before Russia's recent invasion of Ukraine. Obviously, we're seeing heightening sanctions, more volatility in the markets. So can you talk to us a little bit about how the markets are responding to this? And then you talked a little bit about our exposure, but I mean, is there something that we should be doing differently or thinking about differently in response to this new element of geopolitical risk?
Right. Well, I mean, again, let me just come back. The first sort of, if you want to call it good news, is that as an investor right now, towards the beginning of the year, before even the conflict started, in a globally diversified portfolio, particularly in the dimensional approach, the direct exposure to the Russian stock market was very small. It was quite minimal. As I said, less than 10 cents out of $100. So it's really not a huge portion of the global equity allocation. But the question is, what can this crisis do? And very good, follow-up was, what should we think about as investors going forward? And is there something going on right now that should be disconcerting to us as investors as we see the markets choppy every single day going up and down? And I want to start by just laying out a fundamental premise that's going to lead to the conclusion of what we want to do. The fundamental premise is that the stock market allows you and I and everybody on this call to purchase ownership into companies. That's what the stock market's all about, is about buying ownership in companies. It's a phenomenal thing because it gives us all a stake in capitalism. And when you buy an ownership into a company, the value of that ownership really depends ultimately on how much money will the company make. Because if I'm a part owner, I'm entitled to part of those earnings. So when you think about the stock price, it really reflects, what do I expect as an investor looking down years and years down the road in cash flows, in profits coming back to me as a business owner. That's what the stock market's trying to evaluate. It really is about evaluating what are the prospects for this company, what's the company going to make. And then I look, down the road and I make these assessments for 5, 10, 15, 20, sometimes 50 years down the road. And then I kind of determine what is this company's worth. That's the function of the stock market, is to figure out how much is a company worth today based on all the information that we have. Now, when this Russian crisis started, there was already, some level of uncertainty around what these earnings of companies will be. It's always some uncertainty, but particularly when you had the Federal Reserve thinking about raising interest rates, you had, Meta, which is Facebook's parent company, coming and saying, perhaps we're not going to make as much money as we thought. All these things were happening at the beginning of the year. They were already kind of making investors reassess to some degree what are the profits that these companies might make. It's never an easy task, but particularly as you inject more uncertainty, as I mentioned, the Fed or the earnings, and then on top of that, you put this geopolitical risk. What you're seeing is that the markets are really trying to assess right now, how will this conflict impact the profits of McDonald's and Coca-Cola and you name it, and Ford and GM and BMW and all these companies. And that's not an easy task. So when I see the market fluctuating as much as they do, in a way, it is very comforting to me. It is not a sign there's something wrong. It is exactly the opposite. It is a sign that the markets are working. Every single minute as news comes out, you're trying to assess the impact of this news on these companies, and it's not easy. Particularly at the beginning of a conflict, at the beginning of a crisis, things look very uncertain. It is not uncommon to see these bigger market movements. It is something that we saw a few years ago when we had the Fukushima nuclear disaster. If you remember, folks, we had this big disaster, and as it happened, the markets, not just the Japanese market, but markets around the world were fluctuating wildly because there was not a lot of information. But just out of caution, I think there was more of like, let's just perhaps treat this as there is a bleaker view of the future, and that's what the markets were doing in pricing securities. So there was a lot more fluctuation. I mean, the way I thought about it visually is, if you are, sitting next to a pond and the water's calm, and all of a sudden you take a rock and you throw it in the middle of the pond, at the point of impact, the ripples and the waves are going to be quite big. And that's kind of what we're seeing right now. There's an event, there's that rock that landed in the pond, and the ripples are quite big. That's where we are right now. The thing is, what we've also seen over and over and over again in the market, 9/11, you name it, all these situations, is that after the event, the more time you give from the point of impact, the more time it goes from the time when the crisis happened. What you see is that these waves, these ripples, started to smooth out and become smaller and smaller. So just around the type of the event, we've seen this in the past, the market tends to be more volatile because it's harder to figure out what exactly is the impact. What's the impact of this on different companies? And what the market's saying right now is that some companies might actually be suffering. Some companies might not sell as much. Some airlines might have to divert flights, but there are also going to be some companies who are benefiting. Not nefariously, but it just turns out that as oil becomes more expensive, energy companies are going to do well. So their price goes up. So it's not a universal everybody wins or everybody loses. It just depends on a company by company. And that's because of the function of the market. Now, should you do something about it? So ultimately, Lauren, my point in all this is, if you see the markets fluctuating like they have been doing, there's nothing unusual, nothing unprecedented. And in fact, it is a good thing for markets to fluctuate. It's just reflecting the good news and the bad news minute by minute as they come in. And that's exactly what I want the market to do. I want it to fluctuate to reflect those changing expectations company by company. Now, should you be doing something in response to this? We have looked at this over and over and over again. And what we found is that quite often these trades that happen are really driven by emotion, and not necessarily the good time. A lot of times it's fear, it's concern. But what we found over and over and over again is that there is no clear play that you should make. You shouldn't necessarily say, I'm going to get out of airlines and buy energy stocks, because by the time you get around to thinking that, the market has already priced in those good or bad expectations about these companies. So by the time you buy, you're probably going to buy already at a high point. By the time you sell, you'd sell a low point. So there is no obvious strategy to say, I'm going to sell or I'm going to buy. It's not there. What we found the best thing for investors to do, first of all, is to make sure that they have a plan. Something that Lauren talked about earlier in the opening. I think that's probably the most important decision in investing. Figure out why you are investing, When do you need the money? How much money do you need? Because what you find out is that if you are at a point in your life when you need more stability in your money and you need, more income to or cash flows coming from your investment portfolio, you might not be invested in the market as much as you think. You might have a good allocations to bonds, which tend to hold up pretty well. So the first thing is realize that if you have a plan, a portion of your money might be invested in the stock market, but maybe a good portion might not be invested in the stock market. So just figure that out, that it's not that that stocks and bonds are moving the same way in times of crisis. Quite often, what you see is that investors, even as some of them might run out of stocks, might flee out of stocks, a lot of times they're buying bonds. The price of bonds goes up, and there's a nice counterbalance in there. So to me, that's a really important point. Make sure that you know what is the balance between stocks and bonds in your portfolio. The second thing that we noted is that if you look at markets after they take a dip, after there's a 10% drop, let's say a correction, the way the media refers to it, whether you look at 1 year, 3 years, or 5 years out, the returns of the market tend to be pretty much the same as in any other period. In other words, when you look at historical events of this magnitude and you fast forward 1, 3, or 5 years, you don't really see an obvious pattern. More often than not, investors will be ahead by pretty much the historical average. So it doesn't say that you should move out of the market at any point because of something like this. And the third point that I want to make, so in other words, the data, when you look at the data, it doesn't seem to suggest at all that it's going to be a devastation a year from now. It's on the contrary, after these big events, the markets do tend to come back. And the third element is that for anybody who's thinking about selling, what I found is an equally important decision that you ought to make at exactly the same time. When do you get back in? And that's a really, really hard thing to do. Because if you're going to wait for the whole thing to blow out and just finish, and maybe whatever resolution we're going to get to, by the time that happens, the market would have already gone up. So you missed the recovery. So to me, the best course right now for investors is really to acknowledge the emotional impact. It's acknowledged that it is a little scary out there to see it, but the market every single minute is pricing in all the news. And for you, the best course of action is have a financial plan, make sure that you understand the balance between stocks and bonds, and ride this out. It is a better strategy. Now, should you trade at any point? Perhaps. But not because you're afraid or because you don't think things are looking good. When you have a plan, and just for simplicity, you should have half the money in stocks and half the money in bonds. If the stocks drop, then you have a lower percentage in your portfolio in stocks that you ought to have. And sometimes an advisor might look at this and say, it is time to realign the portfolio and kind of bring it back to the right mix. That process is called rebalancing. So sometimes as the market drops because of this bad news, what you ought to think about is perhaps instead of selling more, why don't I buy to bring the portfolio back in alignment through the systematic process, as I mentioned, called rebalancing. It's also true on the upside. If the stocks are running high, you want to trim some of these gains and then rebalance more into bonds. But that is something that an advisor is looking at. Lauren and team are looking at this, and a lot of times it's counterintuitive. As the market drops, what do you want to buy more? That's exactly what good investors do. They look at it as an opportunity, and they use this systematic process to get the portfolio back. So it was a very long-winded answer, Lauren, but I think ultimately, just the gist of it, don't look at the market as something is wrong because it fluctuates a lot. Not at all. It's exactly what it's supposed to do. Secondly, we looked at the data, and there is no evidence to suggest that after these events, things look bad. In the short run, the market tends to get choppier. Over time, they smooth out. And then number three is that if you were to make a move, it's more around rebalancing rather than than selling more stocks. So that's kind of how we look at the Russian situation. And as I said, the good news is that there is no direct impact for you. It's minimal in terms of the allocation to the Russian market.
Perfect. That's really helpful. So we do have some questions coming in around, as you're talking about bonds, interest rates. Interest rates have been very low throughout the pandemic. I mean, I'm thinking we've had physicians refinancing $1 million homes for under 3% over the course of time. The interest rates have started to come up. The Fed has indicated they probably will continue to bring those up. What does that mean for the bond side of the allocation? And does that change anything about how we look at that portion of it in light of what you're talking about with kind of that stock bond balance?
Yeah, no, that's a really good question. So let's review the difference now between stocks and bonds and why might we want to have both. If you look at the stock market, and I'll use the S&P 500 as a proxy for the US stock market, and you look over the long run, what you see is that on average, over the long run, this is again the average, when you look at 90 plus years of data, and we like to use as much data as possible, what you see is that over the long run, the US stock market has delivered to investors return on an annualized basis around 9 to 10% per year. So really a nice growth on an average base in the market. It's more than real estate, whether it's San Francisco, Los Angeles, Nashville, Fort Wayne. It's been a really nice ride for investors. But that's the average annualized return, because what happens is the value of these companies really relies on the profits. As profits fluctuate, so does the market. So even that's the long-term average from year to year, it might look something like this. It might be a bit of a roller coaster, and that's something that we should all understand, is that the stock market is about growth, but it's about fluctuations in value, and it's a rewarding ride, but it's a very choppy ride. And we have a book that is phenomenal. It's called the Matrix book, and we've had this for published this for so many years. And when you look at the Matrix book to get a sense of how rewarding is stock investing and ownership in companies, it's remarkable. $1 invested back in 1926. This is the year when my dad was born, incidentally. By the time he turned 95 last year, one single dollar had turned to over 10,000 in the US stock market, in the S&P 500. So very, very significant growth in the stock market. And I started with the stock market because the stock market is about ownership. It has provided growth, but at the expense of fluctuations in value. What about the bond market? The bonds are about lending. You are lending your money to corporations and governments, when you do that, there's a contract that specifies an interest rate for how long you get that interest rate, and at the back end, you get your principal back. That's what bonds do. It's a form of lending. It's like a type of a loan that you give a company. It's a form of debt. And let's say that you lend your money to the US government for 30 days. After 30 days, you get your money back plus interest. Those are called the 30-day treasury bills. And what you see is that over the long run, going back to the 20s, if you had invested in this type of investment, the 30-day treasury bill, again, looking at the Matrix book, there has never been a single negative calendar year. There's never a year when you open your statement and you say, oh, I look at the 30-day treasury bond index and I see that I lost money. On an annual basis, it never lost money, and you would have earned something in the order of 3-4% annualized on average over the long run. So whereas the stocks are about growth, the bonds are about stability. If people don't like losing money in the stock market, there's something out there that provides a bit of a cushion. And the way I think about it, and I know it's sailing and not Nashville and Fort Wayne might not be necessarily close to a sailing, but what you see sailing is that if you put the sail up, we all know that the boat can go fast, but it's going to toss you around. It's going to go all over the place. That's what the stocks do. They make you go fast, but they also toss you all over the place. Bonds are like the ballast. They slow you down on purpose because they give you stability. And I did this with my brother in the Bay Area. And I'm like, I'm old enough for, I don't really need to be tossed around. I want some stability. I want ballast. I don't really need speed as much. But there's a certain balance for everyone. And that's what bonds are designed to do, is provide that stability, not necessarily growth, not necessarily make you a lot of money. And to illustrate that point, Lauren, it's so fascinating. You look at the Matrix book and he asked the question, if you had invested the same exact dollar over the same time period in bonds, in these 30-day US Treasury bills, what would the same dollar growth be instead of the 10,000? At 9-10% is 10,000 bucks. What do you think it is at 3-4%? I mean, I invite all of the folks on the line to guess the number, but we do have it. I mean, I did look it up in the book, and what you see is the same exact dollar over the same time period invested in the safety of these treasury bills grows to a whopping $22, not missing any zeros. So it is a very different experience. And so the reason that you ought to consider bonds is not because I need to make a lot of money in bonds, but I need that stability. I need something to hold me when the market's not doing well. And I also need something that, counterbalances the market a bit. In other words, it doesn't move in lockstep. When the market's doing, not that well, perhaps these bonds can hold me up. And interestingly enough, that's exactly what we've seen with the bonds historically. If you look at the first quarter of 2020, when the pandemic kind of got a hold of the world, and the S&P 500 was down almost 20%, 19.6%, a US government bond index, a broad basket of these government bonds, was actually up over the same quarter by 8%. And if you look over the past, not just in 2020, the 20 plus years, in every single instance when the stock market dropped significantly, these bonds held up really, really well. And that's the beauty of having bonds. So the point that I'm making ultimately, Lauren, is that when folks are looking at bonds and they're saying interest rates are low, and does it make sense to have bonds? Interest rates are low, but it turns out that these bonds tend to shine because they do not move in lockstep with the market. If we do see a market dip, historically, these bonds held up their value, and that's their role in the portfolio rather than provide growth. Because as you saw, the difference between $10,000 and 22 is just staggering. And if you're looking for growth in bonds, it's not going to be as much certainly as has been in the stock market. So that's our view right now, that it depends on why you hold bonds. But if you're looking at bonds just because I want to have something just in case things don't work out with the market, then bonds are absolutely still doing their job. And it's the best that we have right now.
Perfect. You all are sending in excellent questions, so keep them coming. So I've got a couple here, one that came in from the audience before, one that came in from just as you were talking about interest rates, asking about inflation. Yeah. So lots of headlines about inflation, lots of questions about, should we be concerned? Someone on the line is asking whether or not there's a typical life cycle to an inflationary period. And then, what is there something that we can do to hedge against inflation, or is it just something that we have to take and hope it works out?
It's never nice to whenever people say it is what it is, it's almost like it's out of my hands. And no, let's talk about inflation for a second. And inflation is this idea that prices go up, and it was, prices have been going up tremendously. We feel that at the pump, at the grocery store, so there was no need to kind of sugarcoat it. The prices are going up, no doubt about it. The first comment that I would make is that, first of all, whenever you hear the word inflation, it doesn't necessarily have to be a scary word, because to me, this idea that prices are going up, it's not good for us as consumers. It means that our money doesn't go as far. What I was able to buy last year, let's say for $100, this year might cost me more. Now, here's the thing, Lauren, historically, we have had inflation in the US. The long-term inflation in the US has been about $3, 3%. So if you bought something for $100 last year, well, this year it would cost you probably about $103. That's been the historical average. So we have had inflation, and in fact, to some degree, it is desirable, because we might not like paying inflation, but the reality is that these companies quite often have to borrow money and repay with interest. And in order for them to generate revenue to cover the principal and the interest, they need to have more revenue. And one of the ways to get more revenue is through price increases through inflation. And that's one of the reasons that the Federal Reserve has actually put a target of about 2% per year in inflation. So when you hear the word inflation, I just please think that it's not necessarily scary. Particularly, you look at the long-term average of about 3%. Now, what we see today is much more than that. It's about 7.5%. So it's at that point you say, well, that's different than 3%. And it is for sure that we have higher rates today than we've had in the past. And there are different scenarios about what's causing this and where it's going next. And these two scenarios really revolve around two main ideas. On one hand, you have folks who are saying this is a transitional phase. We have had an economy that was really balanced between goods and services, meaning like we bought refrigerators, but we also went on vacation and got massages. And with the pandemic, we moved to buying a lot more of these goods, the household goods and refrigerators and cars and all that, rather than spend them on services like haircuts, or not me, but other people on haircuts and massages. And this created a lot of demand. And as the demand increased, we also had the pandemic reducing the ability of the economies to produce around the world. So this created a situation where in this phase, when we transition from the pandemic world to the post-pandemic world, which is going to be there soon enough, prices are going to go up. But a lot of economists saying there's no reason to believe that we won't be able to produce at the same levels once we get past these restrictions. And in this period, we are going to have higher inflation, but then it's going to come back down. And, they point to the fact that, a third of the price increase that you see out there has been because of used cars. And why is that? Well, because we had trouble getting chips into cars, the new cars. So they're not new, a lot of new cars are being just put on the lot waiting for the chip. And as the chip production ramps up, there's no reason to believe that we're not going to be able to produce the same number of new cars. So we don't expect prices to grow as much. But that's one scenario. The second scenario is a little different. It says, no, not so fast. What you're seeing is that companies are getting used to passing price increases to consumers. Consumers are getting to be fine paying these higher prices. And then you have workers now demanding higher wages. And as they demand higher wages, then what you see is that the prices will continue to go to cover these higher wages. And you have this, what's called a wage price spiral. And this might continue longer than we want, at perhaps at a higher level. And frankly, right now, neither myself nor the Fed chairman nor the president of the United States, nobody really knows which one of these scenarios will play out. But it turns out there's something very powerful that we have access to, and that is a market signal. It's a way that investors vote with billions of dollars onto these different scenarios, and that vote is reflected into a particular metric that is published by the Federal Reserve and is based on how different bonds are priced. And that metric is called the break-even inflation rate, which I think it's probably what I think is the best way to look at it. It's not an opinion. It's not a forecast. It's how bonds are priced. In other words, how investors are voting with billions of dollars in terms of what they expect inflation to be. So I'm going to share with you the live Fed website on this 5-year break-even inflation rate. And if you want to know what it is, it spells it out right here. Is the value implies what market participants expect inflation to be in the next 5 years on average. So this is really important because it's the combined wisdom of all these market participants, all the expectation when they look at the the wage report, the supply chains, you name it, the shipping problems. And this is what we see. Over the past 5 years, inflation has been unusually low, almost like an anomaly. It didn't even reach the Fed's target of about 2%, which is very, very unusual. We had very low inflation. And then when the pandemic started, we had the opposite concern that prices will not grow. And that's a big issue by itself. But as the economy reopened, stimulus kicked in, where we are today, as of last night, as of Thursday, actually, as of tonight, at the end of the day, the expected inflation over the next 5 years on average is around 3.17%. So what you're seeing right now is that the expectation of inflation over the next 5 years is a bit higher than we've had over the past 5 years. However, the last 5 years have been a bit of an anomaly. It's just been unusually low. And where we are today is actually close enough to the long-term average. That's what's expected to be over the next 5 years. That's what market participants are seeing when they're looking at all the data. Now, this is a referendum in a way that takes place every single day. And the beginning, like a year ago, the expectation is about 2.4% in inflation, and it went up to 2.7. And then soon enough, when the information came out about news on a variety of factors and variables, it dropped. And we had the same thing in the fall. It went from like 2.4 to over 3%, close to where we are today, exactly where we are today. And then it dropped down quickly afterwards to about 2.6. This is not I wouldn't say that this is something that is just a one-time deal. You look at this number and say, aha, that's what I should expect. No, this adjusts every single day. But the reason I'm bringing this up is that it doesn't seem that from the market signal that is probably the most visible to investors, and it's probably the most robust way because it's based on how people invest real dollars. It doesn't seem like it's looking at a system-wide panic or the expectation of really high inflation over the next few years. In fact, it's kind of showing that whatever inflation we've had in the last year, it's going to slow down and taper off. We might never go back to the old prices, but the level of growth is now expected to be sustained at that 6-7% that we've had over the past year or so. And then there's obviously the next question after. The two next questions. One is this related to the stock market? Is the stock market somehow tied into inflation in terms of performance? One of the things, by the way, let me quickly share that because I think it's such an interesting visual to look at how the market and the and inflation are related. So if you look at the bars, they represent the returns in the stock market in the S&P after accounting for inflation, and the yellow dots are the inflation. And what's so interesting is that as you look at these. And you ask, well, how connected are they? Well, you have a year when inflation is roughly the same. And 1 year, the market drops significantly. The other one, it goes up significantly. It's kind of hardest to make an argument, to make a case that inflation is a primary driver of stock market returns. And because of that, we don't suggest that investors should make a move with their money in the market simply because of inflation. Now, in terms of how do you protect yourself, there are two things that you can do. The first thing is to think of something that's called hedging. And what hedging means that every day I look at the inflation, and as the inflation changes, so does the value of my investments. And the way to do that is by looking at certain government bonds. They're called inflation protected securities. And what they do is that as inflation goes up, so does their value. So you're always moving lockstep with inflation. And that's the really good news. You can hedge it every day. Or there are some funds that have other types of regular bonds, but on top of that is something called an inflation swap, which is some sort of an insurance, if you want to put it at a very high level, against inflation, and it pays off if inflation gets high. So there are ways right now, there are tools in the arsenal that Vestia has that would hedge you against inflation. But there's also the bigger question about, maybe I don't want to be protected every day, or I just want to make sure that I stay ahead of it. That when I look down the road, I'll have enough purchasing power in my account to be able to keep the same lifestyle I want. So when we look now at how do different investments perform in years, particularly when inflation is higher, it's quite interesting what we found. And first of all, let me so we started with taking data going back to the 20s. And we went from the highest inflation year and we sorted the data to the lowest inflation year. And just out of curiosity, do you have just a guess? What was the lowest inflation year? Let's start with the lowest inflation. When did that happen? I did not know until I looked at the data recently. It's a bit of a trivia question, but the lowest inflation was actually in 1932. And in that year, the prices actually dropped as a whole by about 10%. So really a big drop in 1932. The highest inflation year, 1946. And it was the year after it ended, the war ended. And one of the main reasons, and we'll come back to this in a second, was the fact that that during the war, there was an Office of Price Administration that set prices from anything from socks to tomato soup to a can of beans. And when that Office of Price Administration went away and the markets went back to supply and demand, obviously prices popped. And in 1946, the prices went up by 18%. It's a significant number. So what we did is we ranked these years by inflation, cut in half. We discarded the lower half, and we only looked at these years as we call them above median inflation years. And we wanted to know how do different investments perform. And if you look at these treasury bills that I mentioned earlier, these very, very safe bills that never lose value on a nominal basis, when you account for inflation, they actually don't keep up with inflation. And as an investor, on an average annual basis, you would have had a negative outcome. You could not keep up with inflation, and you're down by about 0.6%. But some other government bonds, the longer ones, you got back the inflation plus about 0.4% on top. So within bonds, you have to be a little careful. Do I look at the short-term bonds, which are very short-term government bonds, or the longer-term bonds? And you also have corporate bonds. And when you look at corporate bonds, they actually got you inflation back plus about 0.9%. Now, what about the stock market? As a whole, the stock market seems to be doing quite well because it delivered inflation plus 4.9%, and these are above median years. So in these years when inflation was above median, the stock market actually delivered that inflation plus 4.9% more on an annualized average return. And within the stock market, there are these large companies, some tech stocks might be associated to large growth, and they have kept up as well. 4.1%, not as much as the market, but instead of large, you would have done small, and instead of value, you would have done growth. What you saw is that the small value would have had an even better outcome for investors. So all in all, there are certain asset classes that would help. Oh, are we still on? I don't know why it's kind of dropped off for a second.
We're still on. We still have you.
Okay, great. So there's some asset classes that certainly have done well. So I think that if you are looking to outpace inflation, having a diversified portfolio that has some stocks, some bonds would give you a really good chance of outpacing inflation over the long run. If you're interested in hedging it on an everyday basis, you can absolutely do that as well. Now, I want to come back maybe for the last comment. The question that the audience member had, which is a very good one, are there systematic things that you can look in periods of high inflation? And I'm only aware in recent memory, actually going back to in not my time, but my parents' lifetime, there are two instances when we saw really high inflation and some of it a little bit sustained. The first one was in 1946, and I think one of the things that really set it apart was the war. We had the war, and there was a pretty unique event, the magnitude of World War II, and on top of that, having the Office of Price Administration was really a big deal as well. And the reason I bring that up is that the second period when we had high inflation for a more extended period of time, actually this time, was in the 1970s. And part of the reason, which is so interesting, is that the same as in the 1940s, we had price controls. At some point, the U.S. actually moved away from the gold standard, and when that happened, a lot of folks are, imagine how would you have felt, and if somebody told you like from now on the government can print as much money as they want, and they're not bound by anything. Well, it probably was a scary thought. So, in 1971, President Nixon imposed some price and wage controls. And for a year and a half, prices couldn't adjust, wages couldn't adjust. In 1973, when these prices adjusted, boom, everything skyrocketed. So what I think it's interesting to me is that whenever we saw really high inflation, to answer specifically a question, the pattern that at least I found out there economically was that the supply and demand, the markets were not allowed to operate, and the government imposed some sort of controls on prices that replaced the supply and demand, which are the typical market mechanisms. So that to me is one variable that I think it's really interesting, that whenever we saw high inflation, we had also periods when the government imposed these price controls. That's one, at least, the case studies that we have for high inflation, that's one, seems to be one common denominator. The other one is that in the 1970s, we saw that there's a real element of human behavior. And as prices start going up, a lot of workers were worse off. So, you might have gotten an increase of $5 for 100 that he made, so 5% increase in your wages. But if it turns out that it cost you $110 to buy the same things, you're actually worse off because you couldn't even buy the same things, even as your wages went up. So a lot of workers really start pushing for higher wages. And at a time when the unions were really powerful, and not necessarily in a bad thing or a good way, it's just that there was a lot more bargaining power, collective bargaining power. They're able to actually, for their workers, really, do the right thing in a way and try to keep up with inflation. The trouble was that as you have this expectation that wages and prices are going to go up, that becomes a self-fulfilling prophecy. And that's kept for a number of years, the prices up, because the expectation was that inflation will continue to get high. So the point that I'm making here is not just about the economics, but the human behavior and the expectations that people have. And one of the powerful things that happened in the late 70s is the Federal Reserve stepped in and said, it might be economically painful, but we will get inflation under control. And then people started to change their expectations all of a sudden. They're serious about this. So what they start baking into in all the contracts and everything were a lot smaller price increases. So the second common denominator that I find is that a lot of it has to do with the expectations that people have, and that's the big unknown. Are the expectations that we see right now going to be on the high end or the low end? What the market's suggesting right now through the break-even rate is that we will resume something very similar to what we had before the pandemic.
Perfect. Do we have time for one more question?
Of course.
Perfect. So interestingly, as you were talking about the markets, talking about the government, we got a really good question. And again, this is a topic that came in beforehand and also one that's coming in here live, asking about how do you view cryptocurrency as a means of keeping assets that maybe aren't impacted by the government or independent of the government? And if you are going to go into cryptocurrency, how would you think about that in the context of your larger portfolio?
Yeah, that's a great question. So not everybody's familiar. So do you mind if I just take a minute to explain crypto just at a high
Go for
level?
it. Yeah.
So the idea of cryptocurrency is electronic money. And fundamentally, there's nothing new, because if you put money on your Starbucks card, if you have airline miles, that's a form of electronic money. But back in 2009, a group of people or a single individual, nobody knows, it was an anonymously published paper, introduced this idea of a different type of an approach to money and electronic money. And what made it actually quite interesting was some of the ideas that were put forth, and they were put forth exactly at the time when people didn't have a lot of faith in the federal government or the banks, because that was 2009 with the financial crisis. So it really captured people's imaginations that what if we can have a currency that is not tied into a government, that it's kind of like something you can use outside of the financial system, which at the time seemed to be really failing, which certainly hasn't been the case. But the ideas that this introduced were quite clever. The first one is that if you want to move money from one party to another, well, why do we need all these intermediaries? If I want to send money to my brother, it has to go from my Venmo to my bank account to his bank account to his Venmo. It's like it's all this complicated things. Whereas the system basically said, why not just transfer money directly with no intermediaries, and everybody has this digital wallet, and that's how money moves directly from one party to another, make it more streamlined. I think it's a very powerful idea. And it's certainly something that might have legs for the long run. It's conceptually a very interesting idea. The second thing that it introduced that was very clever was that right now, if you have a bank account, there is a centralized ledger that particular company has. The bank has a ledger that keeps track of who owns what. And the idea now is that instead of having one centralized ledger that's controlled by an entity, either government or a bank, why don't we have a decentralized ledger, and all these transactions are being written and validated on many computers. And then once the transaction is validated, it gets written up on all these computers so everybody knows who owns what, and nobody really controls at a centralized level the ledger. It's basically, it's this idea of decentralized ledgers. That technology is called blockchain. So if you hear blockchain, blockchain is just the idea of who keeps track of the money. Instead of a centralized ledger, it's the idea of a decentralized way of keeping track. And I do believe that this has legs and is being implemented in many ways. Bitcoin is just one of the applications that sits on top of this technology called blockchain. There are many other currencies that do the same thing. So long story short, this was designed to be a currency. And we're now about 13 years later, and the question is Bitcoin a currency? And the answer is unequivocally, absolutely not, because the value of the currency changes tremendously from day to day. When anybody associates this with gold or just something that would kind of help me in times of crisis, look what happened on the day when Russia invaded Ukraine. That day, crypto plummeted pretty much like the stock market. So there's no doubt in my mind that if you wanted something, it would to kind of hold up, it would have had exactly the opposite outcome. But it's clearly not a store of value. It does not hold its value. In fact, it actually moves quite significantly more in terms of volatility than the stock market itself. The second thing is it's a medium of exchange. I don't know about you, Lauren, but I don't know anybody who pays in crypto. And in fact, from what I've read, is that a good number of all transactions happening in crypto are for illegal activities, ransomware, kidnapping, drugs, things that none of us really want to be associated with. So it's not really something that you really can spend easily. And in fact, even more weirdly, if you spend money in Bitcoin, that is a taxable transaction. And that makes it even harder, because if you buy a coffee and you use Bitcoin, it could be a taxable transaction that you have to get some tax form saying that you might own tax the government. So in that respect, Bitcoin, let's just make it clear, it is not a currency. And I don't really think that right now Bitcoin has become a currency. And after 13 years, it's kind of hard to imagine that it will become one. Now, then is it an investment? Because people have looked at this and say, well, there's money to be made. Maybe it's an asset class by itself. And I have to say, it is very different than stocks and bonds. I don't look at stocks and bonds the same way as crypto, because when you own a piece of a company, you are entitled to part of the profits that the company makes. And because of that, you can have some form of valuation. I can figure out, if Apple's going to make $10 per year and I'm going to get $1 of that, well, it's probably a good deal if I pay $8 to buy it today. But it's not a good deal to pay $5,000. I can evaluate that and I can find, is it a good deal or not good deal? Because I have some expectations of what I'll receive from Apple, because Apple has real people, real products, real profits. Or even if a company might not have profits today, you expect to make it. Bonds, they pay interest. Real estate, you buy it, you collect rent. All of these are productive assets that have a form of valuation. Bitcoin has none of that. The only reason people buy Bitcoin, and you talk to folks who buy it, is like, why do you do this? Well, because I think somebody else will pay me more in the future. And if you press them a bit, why do you think they'll pay you more? I don't know, it'll just gonna go up. That's the pure definition of speculation. So I think that the way I look at Bitcoin today, Lauren, is a little bit more of a commodity, almost like a speculative commodity. I put in the same category of maybe baseball cards or a bottle of wine or art, when I maybe it's going to go up, I don't know, but I really don't have a way of valuing that. It's not something that I can tie into some economic and investment fundamental. And because of that, what I've come to believe is that if you want to participate in crypto, well, there are certain companies, and we invest in some of those companies that are using blockchain, and they might be making money out of this technology called blockchain. But Bitcoin by itself, I do think that it's more of a speculative play. And if you want to do it, there are other ways to spend money if you do it for the right reasons. If you do it because it says something about you, it's fun, you're not missing out. Do it a little bit on the side, the same way that you would do with other things, that if they don't work out, it's not devastating. If they work out, even great. But I don't look at it to be anywhere near in the same category of stocks, bonds, and real estate. And it comes back ultimately to that question: why are you doing it? Because if you have a financial plan, then that's what Lauren and the team would figure out. Can this actually help you, or does it actually hurt you, or does it matter? And if you want to do it outside of the financial plan, again, there are people spending money on other things. And I have plenty of friends who do it just for fun. It's exciting. It's interesting. It might work out, but I'm not putting my family's assets there. It's just a little something that if it works out, great. If it doesn't, then it's not a big deal. So that's how I look at it. And I wanted to give some perspective because there's so much noise around Bitcoin. I think it's an interesting idea. Do I think Bitcoin's going to be around? Listen, I check my emails on the phone every day, just not on a BlackBerry. I have all the contacts on my phone, just not on a Palm Pilot. Bitcoin might be the first one to arrive, but whether or not this is going to be the future, it's really hard to tell. There is already another technology called Ethereum that is much more sophisticated, and even beyond that, could there be something else? It's just hard to tell right now, and that's why I don't particularly think that from an investment perspective, not speculation, that this is really helping with the financial plan.
Apollo, we've actually gone a little bit beyond the time that we had asked you for this evening, so I really appreciate you hanging with us to share some additional wisdom. Do you have any parting thoughts before we wrap up?
I think that just the biggest parting thought is that we live in very emotional times, and as much as we talk about money, there's so much suffering that's going on, particularly in Ukraine, and it's just really acknowledging just the pain that's going on, and so many millions of people just being impacted by this. And to us, what it does to us. I mean, I know that I've been, glued to the TV, and not because it necessarily impacts me, just that I feel emotion drawn into this, and it's absolutely normal. I think it's absolutely valid to feel the emotions. At the same time, I want to be very careful that the actions that I take are appropriate. And in the case of investing, even as you might feel all this emotion, whether they were excited or scared or whatever the word might be, I don't know that we should necessarily make rash decisions with money, and know that the markets are going to be okay, and you're going to be okay, because people are resilient. Ultimately, people are resilient. And because of that, companies are resilient. A lot of these companies in which we invest, there are thousands of companies in which we invest, and these companies will figure out a way to navigate these times. And that's really important to know. It's about resiliency. People are resilient, so are companies. And because companies are resilient over time, markets have always been resilient. There's always a way that these companies will find, what do I need to do to adjust for that circumstance? As an investor, I think the best thing you can do is just participate in the capital markets, make sure you stay diversified, disciplined, and whenever situations like this happen, look at it more of a situation that I got to be careful not to overreact. On the other hand, if there's something that I can do that would benefit me, like a balancing, let me talk to the advisor and find out. And that really speaks a lot about the role of the advisor, both in managing during these times of crisis, but also implementing the strategy in a very systematic way.
Could not have said it better. So if you are looking for an advisor, if you're not a current client of ours, again, vestiaadvisors.com. You can fill out the form there. We will get in touch with you. Thank you so much, Apollo, for your time. It was great to have you as always. I'm sure we will be doing this again based on some other information that we do not have right now, and a year or so that's going to rock us all over again, right?
There'll always be something, always be.
That's the
always.
journey. Yep, that's the journey in the market. Have a great evening, everyone.